So let's talk about something that's on a lot of people's minds. What's actually better, making a six-figure salary or owning your own business? The answer might not be what you think, because it's not just about what you earn, it's really about what you get to keep. Let's break this down.
All right, first things first. Let's dig into what many people see as this huge milestone of financial success. We're going to take a closer look at why that dream, well, when you get right down to it, can look a little different than you might expect.
For so many of us, this is the number. It's that goalpost, right? The sign that you finally made it in your career. But is hitting that magic number as an employee, is it really the finish line we think it is?
And look, let's be clear. Earning this much is a massive achievement. Hitting 100 grand a year as an employee, that officially puts you in the top 3% of all earners. It's a serious accomplishment, no question about it. But, and this is a big but, here's where the picture starts to get a little fuzzy. Because that big, impressive number on your offer letter, that isn't what you actually get to live on. There's a middleman, and it takes a pretty significant cut before you see a single dime. And boom, there it is. After the government takes its share, that glorious $100,000 salary can shrink to something a lot closer to $65,000 in take-home pay. All of a sudden, that top 3% salary feels a lot less powerful, doesn't it? Well, that's the reality for an employee. Okay, but what if there was another way to make six figures, one that operates on a completely different set of rules? Let's talk about the path of the business owner. Now this right here says it all. It shows the fundamental difference in how money flows. As an employee, you earn your salary, you get taxed immediately, and then you spend whatever's left over. But as a business owner, the whole order is flipped. You earn revenue, you spend on legitimate costs for the business, and then, only then, do you pay taxes on what's remaining. The sequence here is absolutely everything.
So you're probably wondering, how does that even work? Well, it all comes down to a really powerful tool, the tax write-off. And this isn't some shady loophole. It's a core part of the tax code. It just means that the money you spend on necessary expenses to run and grow your business, things the IRS calls ordinary and necessary, that money can be subtracted from your revenue before you calculate the tax you owe.
So what does this actually look like in the real world? Well, that brand new laptop or phone you need for work, that can be a business expense. That trip you have to take for a conference or to go meet a client overseas, also a business expense. These are things you can pay for with pre-tax dollars. And that's really the heart of it, right? By strategically and legally using your business expenses to lower your taxable income, the end result is super simple. You just hold on to more of the money that your business generates. Okay, so let's pull all these threads together. When you put these two paths side by side, one core lesson really stands out, and it can fundamentally change how you look at your income.
This statement really just drives the whole argument home. And look, it's not about being anti-salary, it's about highlighting the incredibly powerful financial structure that comes with ownership, a structure that's actually designed to help you reinvest, grow, and ultimately keep more of your wealth.
So as we wrap this up, the focus really shifts back to you. The real question is about your own financial structure. After looking at these two paths, what's your strategy going to be?